VA loan lets an eligible buyer purchase a home without making a down payment. That sounds like it should always automatically be the cheaper option. But when I compared a VA loan with a conventional mortgage on the same $350,000 house, that wasn't always true. In one example, the conventional loan was cheaper by about $31,900 over 5 years. In the other example, the VA loan was cheaper by just over $4,000. Same house, two different results. So let's walk through the numbers and see what caused the answer to change. In the first setup, the conventional loan comes out cheaper. Over the first 5 years, its financing costs are about $31,900 lower than that of the VA loan's financing costs. By financing costs, I mean money that is actually paid for the loan itself, mainly interest and loan specific fees. I'm not counting the amount used to pay down the mortgage balance, because that money becomes ownership in the house. I'll explain that distinction more in a minute. For now, just remember that in the first example, the conventional loan is clearly cheaper. Then I change the conventional buyer's down payment. Once I make that change, the result flips. Now the VA loan is cheaper by $4,032 over 5 years. Nothing about the house changed. The house still costs $350,000, and I'm still comparing the same 5 year period. The difference is how much the conventional buyer puts down and whether that buyer has to pay mortgage insurance. That's why simply saying VA loans are cheaper or conventional loans are cheaper doesn't really answer the question here. The details of the loan decide the answer. I'm Harrison. I'm an active duty Army officer, and this is Disciplined Dollar. The goal of this channel is to take personal finance decisions that can feel complicated and explain them in simple numbers. This video isn't meant to convince you that the VA loans are always better or somehow are always worse. I'm also not trying to sell you a mortgage. I'm taking the same house and comparing two common ways someone might finance it. Then we can see why one loan is cheaper in one situation and more expensive in another. First, before looking at the first example, we need to establish a few ground rules. First, both buyers purchased the same $350,000 house. That means we're not comparing a cheaper home with a more expensive home. The property is exactly the same in both cases. Two, I'm comparing the cost of the financing only. A mortgage payment normally contains two main parts: the principal and the interest. Principal is the portion that reduces the amount you still owe. As you pay down that principal, you build equity. Equity is simply the part of the house that you own instead of the bank. Interest is different. Interest is what the lender charges you for borrowing the money. Now, because principal becomes equity, I'm not treating it as a financing cost. I'm counting interest, mortgage insurance, and the VA funding fee because those are costs associated with borrowing the money to get the house. I'm also not treating the down payment as money that disappeared. A down payment moves money away from your bank account into the equity of the house. Third, I'm holding the value of the house flat. In other words, I'm not assuming the home rises or falls in value during these 5 years. I'm also excluding property taxes, homeowners insurance, and normal maintenance because both buyers own the same house and would face the same costs either way. The point is to compare the loans, not everything involved with owning a home. Now, we can look at the first example. VA buyer puts $0 down. That means the VA buyer does not use any savings towards the purchase price of the house. The conventional buyer puts down 20%, which equals $70,000. A 20% down payment means the conventional buyer immediately owns $70,000 of the home and needs to borrow only the remaining $280,000. For this example, I'm using the same 6.49% interest rate for both loans. The interest rate is the percentage the lender charges on the unpaid loan balance. Using the same rate helps isolate the effect of the down payment and the VA funding fee. So the biggest difference at the beginning is simple. The VA buyer keeps the $70,000 in cash, while the conventional buyer places that money into the house. The VA loan in this example also has a funding fee. Now, the funding fee is a one time charge connected to using the VA loan program. For this comparison, I'm using a funding fee of 2.15%. So on a $350,000 purchase, the VA buyer could pay the fee up front, but in this example, the fee is added to the mortgage. That means the buyer purchases a $350,000 house but begins with a loan balance of $357,525. The conventional buyer puts down $70,000, so that buyer begins with a loan balance of only $280,000. This is important because interest is calculated using the amount of money still owed. The VA borrower begins by owning more money, so more interest builds over time. The VA buyer kept that $70,000 in cash, but the trade off is a much larger mortgage. Now, here's the 5 year result. During the first 5 years, the VA loan creates approximately $120,091 in financing costs. A conventional loan creates approximately $88,158 in financing costs. Again, these figures are focused on the cost of borrowing the money only. They are not simply the total of every mortgage payment. The VA loan costs more because the VA buyer borrowed a much larger amount and financed the funding fee. Conventional borrower, the conventional buyer borrowed less and did not need private mortgage insurance. So under these assumptions, the conventional loan is significantly cheaper over the first 5 years. But that doesn't mean the conventional buyer is automatically in a better overall financial position. There is still one major difference we need to address. The VA buyer still has $70,000 that the conventional buyer used for the down payment. That gives the VA buyer more liquidity. Liquidity means having money that is available and easy to access. Money in a savings account is liquid because you can use it when you need it. Money placed into a house is less liquid because accessing it usually requires selling the house, refinancing the loan, or borrowing against the equity. But keeping $70,000 in the bank does not mean that the VA buyer saved $70,000. The conventional buyer did not lose that money. The money became equity in the house. So the advantage for the VA buyer is flexibility, not free money. A VA buyer could keep the cash for emergencies, moving costs, repairs, or investments. But whether investing the money could make the VA loan the better choice is a completely separate calculation. It would depend on the investment return, taxes, risk, and how long the money stays invested. For this comparison, I'm not assuming either buyer invests the difference. Because let's face it, most people might not. Now, let's change the conventional loan. Not every conventional buyer has $70,000 available for a 20% down payment. So in the second example, the VA buyer still puts $0 down, but the conventional buyer puts down only 5%. Now 5% of $350,000 is $17,500. That means the conventional buyer now bought $2,500 instead of $280,000. The starting balance is much closer to the VA loan balance. The smaller down payment also creates the conventional buyer to pay private mortgage insurance, commonly called PMI. Now, PMI stands for private mortgage insurance. It is usually required on a conventional loan when the buyer puts down less than 20%. Although the buyer pays for it, PMI primarily protects the lender. It helps reduce the lender's risk if the borrower stops making payments. For this example, I'm using an annual PMI of 0.9%. That adds approximately $249 to the conventional buyer's monthly payment. With the mortgage payment and PMI combined, the conventional buyer pays approximately $2,351 per month. VA buyer pays approximately $2,201 per month. So in this example, the VA payment is about $150 lower each month. The VA borrower still has the larger starting balance and the funding fee, but the VA borrower does not pay PMI. Now, that monthly difference is what begins to change the 5 year result. Here is the result after 5 years. The VA loan creates approximately $115,785 in financing costs, while the conventional loan creates approximately $119,817. That makes the VA loan cheaper by $4,032. The VA loan still has the funding fee. It also begins at a larger loan balance. But in this setup, the conventional buyer's PMI adds enough cost to push the conventional loan above the VA loan. That is the reason the answer changed. The house didn't change, 5 year comparison didn't change. The major change was that the conventional buyer made a smaller down payment and had to pay the PMI. There are 4 main points I would like to take from this example. First, liquidity is not the same as savings. Keeping cash available can be valuable, but moving money into a house does not mean the money vanished. It becomes equity. 2, PMI can completely change the comparison. When a conventional buyer puts down less than 20%, the additional mortgage insurance payment can make the VA loan more competitive. Third, the VA funding fee works against the VA loan at the beginning. When the fee is financed, it increases the amount the buyer owes and causes additional interest to build over time. However, avoiding PMI may eventually make up for that cost. 4. The name on the loan does not determine which one is cheaper. You need to compare the actual interest rate, the loan balance, the funding fee, PMI, closing costs, and the number of years you expect to keep the mortgage. A VA loan could be the better option. A conventional loan can also be the better option. The numbers decide that. And this is where you need to run calculations on your own and see what's best for you. When you when you're preparing to buy, request a written loan estimate from more than one lender. A loan estimate is a standardized document that shows the proposed terms and costs of the mortgage. Compare this interest rate, but don't stop there. Also compare the APR. APR stands for annual percentage rate. It attempts to show the broader yearly cost of the loan by including the interest rate and certain additional charges. Look for points. Points are fees you pay up front in exchange for a lower interest rate. Also look for lender credits. A lender credit means the lender covers part of your upfront cost, usually in exchange for giving you a higher interest rate. Then compare the cash to close. Cash to close is the total amount you must bring to complete the purchase, including the down payment and applicable closing costs. Finally, compare the projected costs over the period you realistically expect to keep the loan. If you think you may sell or refinance in 5 years, the 5 year cost may matter more than what happens over the entire 30-year mortgage. And don't choose a loan based only on the monthly payment. A lower payment can come from borrowing for longer, financing more fees, or paying more money up front. The monthly payment matters, but it does not tell you the entire cost of the transaction. This video is for general educational purposes only. I'm not a financial advisor. This is not financial advice. These examples use specific assumptions, including the interest rate, funding fee, PMI rate, down payment, and 5 year timeline. Your actual numbers will depend on your credit, your VA eligibility, the lender, the location of the home, additional fees, and the rates available when you apply. These are also my personal opinions. Main point is not that one loan is always better. The point is that you should compare both options using your own numbers. A VA loan may be cheaper when the conventional option includes PMI. A conventional loan may be cheaper when the buyer can make a large down payment and avoid PMI. As these examples show, changing one assumption can change the result. I'm Harrison, and this is the Disciplined Dollar. Subscribe for more straightforward, numbers first, personal finance breakdowns.